Hi guys, so in this video we're going to be talking about the various PD arrays that we're going to be using to get our entries on the market. Okay, so now you're getting advanced in the trading system, in the Forex trading system, and now one thing you're going to be doing is to start perfecting your entries in the market. Alright, so we're going to talk about order blocks, we're going to talk about liquidity voids, we're going to talk about breakers, we're going to talk about mitigation blocks. Okay, let's start from the order blocks. All right, if you studied the material we gave you a while back, the candlestick trading bible, okay, it's you might understand the concept of an engulfing candle. Okay, if you understand the concept of an engulfing candle, both bullish engulfing and the bearish engulfing candle, it will help you understand this video better. All right, so if you haven't gotten the material, please go through it. And now let's get into the other blocks now. Another block works on the same principle as it does on the bullish engulfing bar and the bearish engulfing bar. The bullish engulfing bar and the bearish engulfing bar, whereby we have let's say this is we want to represent a bullish engulfing bar now, whereby this is the bullish candle, okay, and this is the bearish candle. It is called an engulfing candle because the bullish candle is engulfing, it's like it's overtaking the bearish candle. Okay, that means the momentum of the bulls is greater than that of the bears. All right, so that is what it is actually just representing on the chart. So it works on the same concept of a bullish engulfing candle now. So let's take this as, for example, as a bullish engulfing candle now. Once you spot this on your chart, okay, once you spot this on that, yes, definitely it's a bullish engulfing candle as it is, but there's something more interesting to it. Yes, it is a bullish engulfing candle. Okay, so it's a bullish engulfing candle. All right, now market will sometimes come back to reprise the bearish candle. Okay, why? Because orders are being accumulated at this point on the candle. So for the bulls to just come into the market and drive price higher, okay, there are still orders that are here. Okay, the bears still have their orders here. So what price will do, so what the market makers will always do is to bring price back to that region. Okay, is to bring price back to that region to test it, and then there will be a massive rejection on the market. Okay, so it works like this. So when market goes like this, comes back, it forms a higher low and then a higher high. All right, so what made it form a higher low here and reject at this particular point is because if it is actually a bullish engulfing candle, it's because they are pending orders right here that the market makers came back to pick up before the pricing is higher. All right, now that is just a simple concept of an order block, and wherever you spot this on your chart, you should have your entry waiting right here. You should have your entry waiting right here. So, and your stop loss should be below the bearish candle. Your stop loss will be at this candle here. So you're pending under, you're going to set the buy limit on this place. You have to set the buy limit on your MetaTrader 4 for that region. So once price comes back, it picks your limit. You're joining the market, the BFIs. You're already joining the BFIs already, and then you're riding the wave with them. All right, now it's the same concept works for the bearish engulfing candle. All right, the same concept works for the bearish engulfing candle. Let's say whereby this is whereby the bearish candle is engulfing the bullish candle, something like this. Okay, let me try. What about the bearish candle is engulfing the bullish candle? All right, something like this, perfectly. All right, so it's going to be engulfing candle, bearish engulfing candle. All right, now the same principle works for it also, whereby there are probably buyers here in the market, and then the sellers just hopped in and then sold their major position and then drive price lower. Okay, so definitely there's going to be sometimes there's going to be a repricing back towards that area. So what you should do is to have your pending order waiting for you right here. Okay, once you have your pending order waiting for you right there, you have to open your short position right here. Okay, put your stop loss at the close of the open of the bearish candle. Okay, so yeah, so what will now happen will be something like this. Okay, there will be another candle that will come back to touch it. The color should be ash color. That will come back to touch it before continuing lower again, to engulf it again. Okay, it still works on the same principle of a higher high and a higher low. Works on the higher high, higher low model and the lower high, lower low models. Okay, it is all still the same concept. Okay, let me now show you something like that on the chart. I think I have one marked out here. Okay, this is a bearish engulfing. If you watch this very well, okay, if you watch this very well, this is a bullish candle. This is a bearish engulfing candle. It engulfs this bullish candle. Okay, like I said, there's going to always be a reprise. The market makers will always drive price back towards that region, okay, to pick up orders right there. And you know what's going to be happening. You're going to be having your pending limits here. Okay, your stop loss is over here at the close of the candle, and then you take profit at the next point of liquidity. And you know what to do. Next point of liquidity is somehow here, and then boom, you make sure your risk to reward ratio is okay. Yeah, 3:1. Remember, you always have to be a good risk manager also. Okay, you see how it picks your entry, and then boom, straight into the markets. Profit as usual. Okay, not really as usual though. There are losses in the market, but as far as you have a disciplined risk management strategy, you're good. Okay, and now that is just how the principle of another block works. Now let me try to show you one on the chart of a bullish order block. Let me see if I have one. Yes, I have one right here. Okay, now look at this. This is a bearish engulfing candle right here, and then this is the bullish candle. Okay, so if I pick up my I know that, yeah, definitely at the open of the candle there's going to be a reprising later on. Okay, so what I do is that I put my pending limit here to buy. Okay, when I put my pending limit to buy, I put my stop loss at the close of the candle. Okay, and then I put it at the next point of liquidity, which is somehow here or here, anyone. And you see what happens. Market respects my order, market respects me, picks up my order, respects it, and then boom, takes me up into profit. As simple as it is. That is just basically the concept of an order block. And knowing this concept alone can make you a profitable Forex trader if you'll be following me up on all these videos. Alright, so now let's talk about a liquidity void. What is a liquidity void? Okay, I know this might sound odd, but yes. A liquidity void, no, remember I told you liquidity is definitely anywhere on the chart where the BFIs have their pending orders at, where the stack up positions are, where there's money at. Alright, so now, another thing. When there's a strong movement on the chart, okay, for there to be a strong movement on the chart, you need massive funds to move price from one point to the other. And representing this to the chart will leave gaps in price. It will actually leave gap in price. You might just see a very long wick up, a very long bullish candle, or a very long bearish candle. Okay, now what that leaves, that whole bearish move, if you're looking at my chart now, let me look for one. That, okay, maybe a very strong move in the market. Okay, yeah, now let's look at this on a monthly time frame. Okay. Look at this on the monthly time frame. Okay, now watch this. See this whole move? Look at this move here. This is a very strong bearish move. Okay, must have left it left a very strong, it's a very strong momentum in price. Okay, now this is a liquidity void. Now what happens in a liquidity void? Once that gap is made, the gap will always be filled. Meaning market makers will always go back to fill up that gap. We always reprice back to that level. So again, it gives you a target in the market, okay? It gives you a repricing in the market. All right, so if you're putting a take profit over here, and maybe you had a reason to enter the trade over here, all right, and you see what market did, it went, and then it always, now this is, don't say Abuki says this, all right, but 80% of the time, okay, price will always come back to fill those voids. And you know what to do when I say it always comes back to fill those voids. Okay, you always trade once you spotted a reversal pattern. Okay, once you spotted a reversal pattern, your target should be above those voids. Your target should be within those voids. Okay, because you know that market is always going to fill those voids. All right, now that's one on liquidity void. Very simple and effective. Trust me, I've been trading the forex market for over a while now. And these are stuff I use, these are concepts I use to actively trade the forex market. All right. So now let's talk about a breaker and a mitigation block. They sound different, almost similar, but they are different. All right. Now, let me give you a plain chart. Now, a breaker is a pattern. It's not necessarily a pattern, it's more of a template, right? That you use once you understand the template and once you understand the pattern, all right? Once you're able to identify it on your chart, all right, it's going to give you a directional bias in price. Now, a breaker will look like this, bullish or bearish. So a bullish breaker will look something like this, all right? When the market is trending, okay? Now, it's more of like a liquidity grab both ways. Let's say it's more of like breaking market structure both ways, all right? Now, when it makes a lower high, okay, it breaks market structure, okay, it breaks market structure, and it breaks the other market structure, okay, and then it comes back to retest this region, and then it continues higher. This is the concept of a breaker, a bullish breaker, to be precise, whereby it makes a low, it makes a lower high, it makes a lower low, then it breaks market structure with a very strong impulsive move. Now, this impulsive move is very, very important when it comes to a breaker. And I've been using this template for a while now, and trust me, it works almost 90% of the time. Once I see that it makes, okay, market is making a lower high, lower low, or a higher high, a higher low, okay, and then I see a strong impulsive movement to break market structure, all right, to break market structure, and there's always going to be a retracement. Now, that retracement is where you're looking to pick your entry from. Okay, that retracement is where you're looking to pick your entry from. Okay, there's going to be, maybe there might be another block around here, or maybe not. Okay, but this region is where you want to look at. Okay, this region, it wants to look like a normal breaking market structure, yes, but there's something unique about a breaker. Okay, there's something unique about the breaker, and that is what that means. It has to clear this liquidity. It has to make a lower low or a higher high before it breaks market structure. It needs to make it. It can't shift. Okay, if it shifts, it's not valid. All right, it needs to break market structure with an impulsive move, with a strong move, before it is recognized as a breaker, bullish or bearish. Okay, so now when market comes back to retrace, Remember, it will make a liquidity void. All right. So when market comes back to retrace, okay, to fill up the gap, to tap the other block at this region here, or not, there might not be another block there, but it will definitely come back. But once you retrace, that is where you're looking to enter from. All right. So imagine you're entering this at this price here. Okay, you're putting maybe 30 pips. Okay, then you're holding it. Your take profit is somewhere here. It's simple. This is the simple concept of a breaker. This is the concept of a breaker. Okay, now, a mitigation block is just like a breaker, but it's not a breaker. Okay, whereby in the sense that market does not necessarily need to break market structure. Okay, it doesn't really need to break market structure. It just needs to continue. Keep on making lower low and lower highs, lower low, lower high, or higher highs and higher lows. All right. Now, a mitigation block is like this. It's simple. It's like this. Okay, let's say in a downtrend market. Okay, market keeps on coming like this, like this. Now, this right here, okay, is a mitigation. This is a mitigation point. Okay, this is a mitigation point. Okay, for it to come back to hit it, go lower again, hit it, another one, go lower again, hit it to go lower again. So it's just like the market does normally making higher highs and higher lows, or lower lows and lower highs, but knowing where to precisely pick it from is a mitigation block, and it's those regions, okay, that you want to start looking out for. Okay, now, funny enough, there might be another block at maybe any of this, within the middle of any of these regions. Okay, there might be another block lying there. Okay, that's where you want to pick your entry from. All right, so that's just it on a mitigation block, a bullish breaker or a bearish breaker, a liquidity void, and an order block. All right, on the next video, I'm going to be showing you how to refine your entries in the market.